Right, bear with me because we have got a lot of facts to get through today on this video, and that's what we deal with on this channel, facts. The average bear market lasts for about 19 months. Don't forget, typically a bear market is when the S&P 500 drops by 20% from its all-time high. And last month, on the 13th of June, we officially entered a bear market. On top of this, usually a bear market precedes a recession. But historically, bear markets that don't precedes a recession often last much less longer. Now, no two bear markets are the same, and this bear market took 161 days to drop from all-time highs. That's compared to an average of 245 days in the past. I don't even know why I'm wearing these. I'm not even reading glasses. I use them for driving. History again has shown that quick descents often lead to less impactful mega meltdowns from an economic perspective. And overall, since 1945, the S&P 500 has dropped by an average of 32%, and it took them 12 months on average to get there. From there, it has taken on average 23 months to recoup its losses. However, the most recent bear market in March 2020, that only lasted 31 days. And the dot-com bubble burst lasted 31 months. So what do we do with all of this information? Well, famously and often quoted as the most dangerous words in investing are, "This time it's different." However, what we do have to do again is look at some facts. First of all, inflation. And we've all heard about it, and it's just hit 9.1%. This is the highest it's been for 40 years. Something that people often overlook, they don't realize, is inflation doesn't go backwards. This 9% increase will not be met by a 9% decrease next year and everything's going to go back to normal. These prices are here to stay. There's only been 4 instances of significant deflation in the history of recording these things, and the last one was in the 1930s. So don't think that things are going to go back to normal next year. That's not going to happen. So this isn't just a bump in the road. These things are here to stay. The cost of your tin of beans is not going to go back down. So what this means is, unless you can out-earn inflation, unless you got a pay rise of over 9.1% this year, that means the amount of money you can spend, the amount of money that you have, is worth less. By the way, figures from the ONS have shown that the average pay increase this year has been 4.2%. That's way off 9.1% increase in inflation. Most people are worse off. Now, further to this, we've seen interest rates starting to creep back up again. And the theory behind this is banks will increase interest rates. That will make borrowing more expensive. And if it's more expensive, less people will borrow. And if less people and businesses are borrowing, less people and businesses will buy stuff, basically. They will spend less. Spending less, buying less stuff means that it's supply and demand. It's the old adage, prices should come down. Well, people spending less, of course, means that businesses are going to struggle because people are putting less money into the economy. You tell me what you think that will do to the price of stocks that are in the consumer goods sector, for example. Now, again, it's important to know that a big part of inflation has been caused by external factors outside of our control. These are things like the prices of global energy, which is very little that we can do about, which means how impactful can these interest rates potentially be? It remains to be seen. But what does all of this bloody mean, and what am I doing? Well, like I said at the beginning, no two bear markets are the same. On top of this, no one knows what's going to happen next. Those that do, get lucky. And there's been a lot of that over the course of the last couple of years with picking random stocks. We got lucky in certain circumstances. But how many people in 2008 predicted the housing crisis? One. Michael Burry. And yes, he may well have been a very talented and brave investor, but he was pretty much the only person on the planet who predicted it and who hedged a lot of cash against it. So he made $100 million in doing so. But there's 7 billion people on this planet, and only one person predicted that that was going to happen. So how do you fancy your odds in terms of predicting what's going to happen next in the stock market? So what am I doing then? Well, new people to this channel probably won't know, but what I'm investing for is financial freedom. That is my ambition. I'm trying to do that inside 10, 11 years. I am trying to invest aggressively in terms of trying to be able to achieve that. So I am taking advantage of the current situation whilst I am fortunate enough to be able to do so. I've increased my deposits into my ISA to £1,700 a month, and I'm absolutely trying to max out my exposure to this opportunity as I see it. I honestly believe that this is the opportunity of a lifetime for those of us that are actively investing at the moment. I think we will look back in the future at this period, however long this bear market is, and we will think to ourselves, thank God I either invested during that period, or why the hell didn't I? I want to be in the former rather than the latter. Millionaires are made much more commonly and much more easily during bear markets than they are during bull markets. We've all read the books. We all know the score. We just have to act upon it. Some people say that's the hardest thing. The hardest thing about investing is the psychology behind it. But we know what we need to do. We know what the facts are. We know what's happened in the past. The stock market will recover. It will beat all-time highs again. I guarantee you that. It's just a case of when. How long does it take to get back up there again? Now let's wheel out that old cliche from Big Boy Buffett. It is completely relevant at this time. You should sell stocks when others are greedy, and you should buy stocks when others are fearful. Essentially what he's saying is you should be buying when everyone else is selling because it's pushing the price down and you're going to get a bloody bargain. I can give you a couple of signs that people are fearful at the moment. First of all, of course, the stock market is crashing. It's the most obvious one that we can see. We've dropped by, 30% now since the beginning of the year. It's dropped significantly, the most amount for a very, very long time. It's an opportunity. People are selling. Take advantage of that opportunity. The second thing is you just need to look a little bit closer to home. Have a look on YouTube. Every second video is doom and gloom. Every second video is full of, this is bad. This is terrible. It's going to get worse. Well, if it gets worse, it gets better as far as I'm concerned. If the stock market declines more, it's more of a buying opportunity as far as I am concerned. This is not a bad situation to be in if you are a long-term investor. This is bloody good. This is the time to do as you preach, to do as you've read, to stick to your plan, to continue doing what you've said you would do during these hard times. I hope that this market continues to decline for 2 years. I hope that we're stuck in a bear market for 2 years because it gives me 2 years to max out that exposure. Now, in 10 years' time, I will look back at this as being the opportunity that I took to build the wealth that I have now. If you want to look at my portfolio to see how I am doing exactly that, you just need to watch this video here.